Hi there. In this video, we'll explain how HMRC uses technology and data analysis to identify undeclared income.
Let's say you just finished a quick freelance job and the client hands you £500 in cash, or maybe they ping it straight to your phone. For a lot of people, the immediate thought is, great, that's completely off the radar. Welcome to The Explainer. I'm brought to you today by My Tax Accountant, or MTA. We're looking specifically at what the UK's shifting tax landscape means for sole traders and freelancers, bringing in between £30,000 and £60,000 a year. Right now, the UK is dealing with a £46.8 billion tax gap, the difference between what's owed to the government and what actually gets collected. To reclaim those missing billions, HM Revenue and Customs has moved away from regional manual audits. Instead, they've invested £175 million into a British firm called Quantexa to modernize an artificial intelligence platform known as Connect. This system actively processes over 22 billion lines of taxpayer data, drawing from dozens of different financial, property, and civic sources. This means an undeclared cash payment is no longer a secret kept from an overworked auditor. It is now a data point that must contend with a mathematical algorithm designed to identify patterns that human eyes usually miss. You've probably heard the old myth that running a cash-only cafe or plumbing business leaves no digital trail. HMRC uses dynamic benchmarking. The AI calculates the standard cash-to-card ratio for your specific business type and postcode. If a business pockets cash sales, their ratio plummets. This makes them a statistical outlier, automatically triggering a warning flag. The tax authority doesn't need to physically find the cash. The algorithm simply highlights that the declared numbers are mathematically inconsistent with the market. There's a similar misconception about the digital economy, the idea that side income generated on digital platforms stays private. Since January 2024, digital platforms like Airbnb, Etsy, Vinted, and Uber have been legally required to pipe user income data directly to HMRC. This visibility is expanding further. In January 2026, the Crypto Asset Reporting Framework, or CARF, goes live. This requires UK crypto exchanges to collect transaction data and automatically report decentralized finance activity to the government. Now, you might see headlines claiming tax agents are manually scrolling through your Instagram holiday photos to catch you out. They don't need to. The Connect system automatically cross-references your bank deposits, property registry data, and platform payouts to build a profile. Any digital side hustle is natively integrated into HMRC's tax visibility net. The concept of an off-the-books gig has been rendered obsolete by this data sharing. To process all this incoming information, the UK is rolling out Making Tax Digital for income tax. By April 2026, it becomes mandatory for sole traders and landlords with gross incomes over £50,000. This timeline graphic illustrates the change in the reporting cycle. The government is replacing the traditional annual self-assessment with mandatory quarterly digital updates, followed by a final consolidated declaration every January. These quarterly pipelines give HMRC near real-time visibility into the cash flows of small businesses. This compresses the window for compliance interventions from several years after a transaction down to mere months. This move terminates the era of retrospective end-of-year tax planning. Compliance is now a continuous, year-round requirement. When the algorithm detects a discrepancy, it triggers an automated nudge letter. This document serves as a pre-investigation prompt, giving taxpayers a window to review their records and voluntarily disclose errors before formal enforcement begins. How you respond to that letter dictates the financial penalty. If you make a voluntary disclosure for a careless mistake, penalties can be as low as 0%. But if the system identifies deliberate evasion, those fines can reach 100% of the tax owed. Because an algorithm can flag innocent transactions as suspicious, survival now depends on maintaining an airtight paper trail. To defend your position, you should keep business and personal accounts strictly separate and use digitally linked records to prove exactly where every pound originated. AI benchmarking makes cash suppression statistically visible. Digital platforms now report your earnings automatically, and Making Tax Digital grants the government real-time oversight of your accounts. To ensure you have the right records in place before a nudge letter arrives, reach out to My Tax Accountant. Get your digital reporting sorted today.